U.S. tax changes. What's shifting for 2025 and 2026? The IRS recently announced a sweeping set of inflation adjustments and law-based changes that will affect Americans' tax burdens, both in 2025, returns filed in 2026, and 2026, returns filed in 2027. Many of these adjustments aim to lessen the impact of bracket creep, where inflation pushes more income into higher tax brackets without real increases in purchasing power. Some of these changes originate purely from inflation indexing, while others stem from the new One Big Beautiful Bill Act, OBBB or OBBB Act, passed in 2025. Let's break down what's new, what's carried forward, and what to watch out for. Major adjustments at a glance. 1. Standard deduction rises further. Because many taxpayers take the standard deduction rather than itemizing, changes here matter a lot. For tax year 2025, returns filed in 2026, the standard deduction was bumped under OBBB to $15,750 for single filers, from $15,000. $31,500 for married filing jointly, from $30,000. $23,625 for heads of household, from $22,500. For tax year 2026, returns filed in 2027, the IRS has further inflation-adjusted those. $16,100 single/married filing separately. $32,200 married filing jointly. $24,150 heads of household. Because the deduction is bigger, more income can be moved into the zero bracket, reducing how much of people's earnings are taxed. This is exactly what proponents mean by inflation will take less of a bite, as Tom O'Sabin described in Article 1. 2. Revised income tax brackets for 2026. The IRS has adjusted the thresholds for the familiar 7 federal tax rates. For 2026, 10% on the first $12,400 of taxable income, single/$24,800, joint. 12% on income above those until the next threshold. 22% begins above $50,400, single/$100,800, joint. 24% above $105,700, single/$211,400, joint. 32% above $201,775, single/$403,550, joint. 35% above $256,225, single/$512,450, joint. 37% above $640,600, single/$768,700, joint. Importantly, moving into a higher bracket doesn't mean your entire income is taxed at the higher rate. Only the portion above the bracket's threshold is taxed at that higher rate. This is standard with U.S. progressive taxation. Because the brackets are bumped upward, many taxpayers will avoid being pushed into higher tax rates merely because of inflation, one of the IRS's goals. 3. Other inflation-indexed provisions. Beyond standard deductions and brackets, the IRS makes adjustments to many other tax provisions each year. For 2026, these include Earned Income Tax Credit, EITC. The maximum increases for taxpayers with 3 or more children rises to $8,231, up from $8,046. Alternative Minimum Tax, AMT, exemptions. The exemption for unmarried individuals is set at $90,100, with phase-out beginning at $500,000. Estate tax, basic exclusion. The exclusion rises to $15 million for estates in 2026, from $13,990,000 in 2025. Adoption credit. The maximum credit for qualified adoption expenses becomes $17,670, up from $17,280. Employer-provided child care credit. The cap is increased from $150,000 to $500,000, or $600,000 for certain small businesses. Health FSA, flexible spending accounts. The maximum salary reduction amount is $3,400, up from $3,300. Foreign earned income exclusion increases to $132,900 from $130,000. Annual gift exclusion remains at $19,000, though spousal non-citizen limits increase. These adjustments are automatic in many cases. The IRS does them annually via its Revenue Procedure announcements. The influence of the One Big Beautiful Bill, OBBB. While many of the changes are due to inflation indexing, the OBBB Act introduces additional structural changes that layer on top of the annual adjustments. Here are the key features. 1. Extended/permanent tax cuts from 2017 Act. The OBBB permanently enshrines many of the tax rate cuts from the 2017 Tax Cuts and Jobs Act, TCJA, that were originally scheduled to expire in 2025. 2. $6,000 senior deduction, temporary. One of the most talked about provisions is a new, temporary deduction for taxpayers age 65 and older. Each eligible individual may claim up to $6,000 in additional deduction, or $12,000 for a married couple if both are eligible. This deduction is available for tax years 2025 through 2028. The deduction phases out for individuals whose modified adjusted gross income, MAGI, exceeds $75,000, or $150,000 for joint filers. In practice, this means many Social Security recipients who used to owe tax on a portion of their benefits will now pay zero federal income tax on those benefits. The White House claims this will result in 88% of seniors paying zero taxes on their Social Security income. However, note the nuance. The law does not outright eliminate taxes on Social Security for all. It provides this deduction so that for many seniors, the taxes owed drop to zero. 3. New deductions, tips, overtime, auto loan interest, SALT cap expansion. The OBBB introduces or expands deductions in several areas. Tips and overtime deductions, up to $25,000 in tip income and $12,500 in overtime income, or double these amounts for joint filers, may be deductible. Phase-outs apply for higher incomes. Auto loan interest deduction. For new cars with final assembly in the U.S., interest up to $10,000 may be deductible, subject to income caps. State and local tax, SALT, deduction cap raised temporarily. The old cap was $10,000. Under OBBB, it is increased to $40,000, or $20,000 for married filing separately, through 2029. Above-the-line charitable deduction. A $1,000 deduction for individuals, or $2,000 joint, for charitable contributions. AMT changes/exemptions. The OBBB restores and index adjusts certain AMT exemptions and phase-outs. GILTI/FDDEI/NCTI provisions. The law makes changes to how foreign income is taxed, including setting new deduction percentages for net CFC-tested income and foreign-derived eligible income. These new or expanded deductions can materially reduce taxable income for many taxpayers, especially those in professions with tips, overtime, or large state and local tax burdens. 4. Trade-offs and restrictions. With any tax bill of this size, there are trade-offs. The senior deduction is temporary and subject to income phase-outs, so high earners may see limited benefit. The SALT expansion is also temporary, through 2029, and phases down for very high incomes. The cost of these tax changes is large. Critics argue it will substantially increase the federal deficit. Some deductions, tips, overtime, have phase-outs when AGI gets large. What it means for taxpayers, scenarios and impacts. Scenario A. Middle-income worker, no dependents. Suppose you're a single filer earning $70,000 in 2026. With the higher standard deduction, $16,100, and the bumped brackets, your taxable income shrinks and your marginal tax rate applies at a slightly higher threshold. If you do overtime or receive tips, you may also benefit from the new deductions if you qualify under AGI limits. You'd see modest relief compared to previous years, especially as inflation alone would have raised your income without raising thresholds. Scenario B. Senior receiving Social Security. You are 65 plus and receive Social Security plus other income. Many seniors already paid zero tax on a portion of Social Security, but with the new $6,000 deduction, that number expands. The White House claims 88% of seniors will pay no tax on Social Security under these rules. But this benefit phases out for people with MAGI above $75,000, single, or $150,000, joint. In practice, many middle and upper-middle income retirees will see the biggest relief. Scenario C. High state tax state resident. Imagine you live in a high-tax state and pay $25,000 in state and local taxes. Under old rules, only $10,000 of that was deductible for federal income tax. Under OBBB, that cap is expanded to $40,000 temporarily. This change could significantly improve deductions for many taxpayers in states like New York, California, etc. But be cautious. Very high incomes may face phase-downs of that expanded cap. Effective versus marginal tax rates. One must remember the difference. Marginal rate equals the rate applied to the last dollar of taxable income. Effective rate equals the average rate of all taxable income. Because of these shifts, higher deductions, boosted brackets, many taxpayers' effective rates may drop, even if their marginal rate remains the same or higher. Challenges, risks, and things to watch. 1. IRS staffing and operational strain. The IRS is facing serious operational challenges. After a series of budget cuts and staff reductions, there are worries about slow processing times, delays, and errors as they implement these new provisions. Even the National Taxpayer Advocate is sounding warnings that the 2026 tax filing season may be rough. 2. Legislative uncertainty. While the OBBB law is passed, many of its benefits, especially the senior deduction, SALT expansion, etc., are temporary. They expire in 2028 or 2029 unless Congress renews them. Thus, relying on them for long-term planning is risky. 3. Phase-outs and limits. Many of the more generous benefits phase out at higher income levels, so high earners may see diminishing returns. 4. Deficit and fiscal pressure. These tax benefits come at a cost. The expanded deductions, extended rate cuts, and other changes may worsen the federal deficit unless offset by spending cuts or future revenue increases. Some critics argue the bill disproportionately benefits higher-income households. In fact, the Tax Policy Center analysis cited by CBS suggests that $6 in $10 of tax breaks will go to the top 20% of households. Tips for tax planning in this new landscape. 1. Revisit with a tax professional. Many of these changes are complex, and your personal income mix matters: wages, investments, Social Security, etc. 2. Monitor your AGI, especially if you're near phase-out thresholds, senior deduction, SALT cap, etc. 3. Keep good records on tips, overtime, and other income sources. Now they may yield extra deductions. 4. Watch legislative developments. Some provisions may be extended, altered, or allowed to expire. 5. Plan for future years. Don't assume today's deductions will last forever. 6. Stay aware of IRS processing risks. File early, keep backup documentation, and be patient if processing is slower. Conclusion. The combined effect of inflation adjustments and the new One Big Beautiful Bill Act creates a shifting tax terrain. For many taxpayers, especially middle-income and retirees, these changes offer real tax relief by expanding deductions and raising bracket thresholds. But the benefits are not uniform. Upper-income individuals may see limited gains, and many provisions are temporary or subject to phase-outs. As always, the best approach is to stay informed, plan ahead, and lean on trusted tax professionals to tailor strategy to your situation.